Good afternoon, everyone. I'm Matt Dimitroshin. I'm the Director of Investments here at Telemus Capital. Thank you all for taking time out of your day to join us here for our update market analysis, where we're going to kind of talk about what's going on with COVID-19, what's happened in the crude oil markets, and with some of the stimulus impacts that are going on out there. The agenda today is I kind of wanted to walk through it, was to start out with just kind of a market update, and let's kind of talk about what's really been going on in the market over the last month, as we've seen a pretty significant drawdown in the equity markets, and then kind of walk through the economic impact of the coronavirus pandemic. Talk about the oil markets, which is just another leg to the stool that's impacted the economy and the markets. And then walk through kind of the portfolio positioning of kind of how to think about your portfolio, how we're looking at the portfolios here for our clients at Telemus, and then look at what some of the opportunities we're seeing out there, in particular, one in particular that just to highlight what we're seeing in the market. So let's start with a market update. And I guess before I get too far into that, if you have questions, please feel free to enter them kind of into the chat box, and we'll get to questions at the end of the discussion. So as we're looking at the markets and the equity market, so the equity market kind of peaked on February 19th, and kind of we started the downturn beginning on February 20th. And so what I wanted to do is just kind of highlight, since February 20th, what have we kind of experienced in terms of the drawdown. And so as of the close yesterday, the S&P 500 has declined 25%. We'd like to look at the broad equity indexes in the US and kind of also thinking about them in terms of growth and value stocks. So growth stocks being companies whose earnings are growing at a faster rate than average, and value stocks being those that have low valuations, particularly price to earnings or price to book multiples is kind of the nomenclature we use to look at value stock. And what we've seen is they've both fallen, but value stocks have fallen a little bit more than growth, which is a trend that's actually been in place for a number of years. And in fact, year to date, growth stocks are outperforming value stocks by 10 percentage points. In the past month, or since February 20th, growth stocks have outpaced value stocks by 4 percentage points. Small caps in the US, which is really measured by the Russell 2000 index, small caps have lagged their large cap peers by 10 percentage points. So small cap stocks are down 35%. Versus the S&P 500 down 25%. And then if you look outside the US, the MSCI EAFE index really measures the developing markets, so Europe, Japan, and the like. That index is down 28%, so a little worse, but not a whole lot from kind of the US. And then emerging market stocks are down on 24.5%, or pretty much on par with the S&P 500. The one thing we have seen is lower volatility stocks have exhibited less downside. It's kind of what we would expect in a big drawdown like this. Lower volatility stocks are really those stocks whose prices tend not to move around as much as the market. So companies like Coca-Cola, Visa, Verizon that are pretty steady Eddie in their business model, those have held up a little bit better. The other thing I would point out is we are down 25% from the peak on February 19th. But, you know, looking back at, and I heard this from a strategist a couple of days ago, looking back and kind of past drawdowns in the market, the peak to trough decline for a bear market has averaged 32%. So we've experienced a lot of that pain in just a short period of time. And it just kind of puts in perspective that these drawdowns like this happen. They tend to maybe not happen as quickly as we've experienced or as violently as we've experienced, but this is part of the natural evolution of the market cycles. And these bear market drawdowns do happen similar to what we've experienced of late. The other piece I want to talk about in the equity markets is volatility. And this chart looks at the CBOE, or Chicago Board of Options Exchange Volatility Index, also known as the VIX. And it really is a measure at looking at what kind of volatility is implied in options contracts on the S&P 500. And the important thing here is just to look at the levels of it. We've now, on Monday, we actually eclipsed a reading on the VIX that was higher than what we experienced during the financial crisis. The VIX had peaked at a level of 81 and change during the financial crisis, and I believe on Monday we had actually hit 83 and change at one point intraday. And so the VIX is clearly at elevated levels, and we can see it, right? We saw Thursday the market was down over 10%, and Friday it rallied back 9% and change, and Monday it was down 12%. And so we're really seeing those big ups and downs in volatility. And those ups and downs are painful regardless. The other thing I think to point out is really for the 5 years before this, we've had really low volatility. There have been periods and episodes like the fourth quarter of 2008 where we saw some volatility spikes, but for most of the last 5 years, we've had really low volatility, meaning the market was up or down by, 0.5% or 1/4% any given day. And so now not only are we away from those periods, but we're seeing these big significant moves in the market. One of the things to point out there, I think what we're seeing is we're getting a ton of news and a ton of information every day, whether that's on government efforts to combat coronavirus, whether it's fiscal and monetary policy, what's happening overseas and in different markets. And then you're seeing a lot of company specific news, and we're all kind of quarantined as well on top of that. And what I think is really causing the volatility, and what's important to keep in mind as we're watching these big violent days, is we haven't really seen an equilibrium yet between sellers and buyers. And so there is going to come a point where there are going to be buyers that are going to say, this is a good level, I'm comfortable buying in at this point. And when that happens, you're going to start to see a level of support. I'd like to believe we're getting closer to that. A key indicator of that is if you look on Monday, we had pretty low volumes in the market. So it was a big down day, but it wasn't mass selling that was driving it. It was selling pressure, but not at high levels of volume. So that can be a sign that maybe we're starting to maybe see signs that we could be getting back to that point of equilibrium where buyers and sellers are on equal footing, and that's kind of what we're looking for. I tuned into a conversation the other day with Ron Temple, who's the head of equities at Lazard Asset Management, and Ron's a very thoughtful investor. I've known him for well over a decade, and Ron used a saying that, or made a statement that really resonated with me, and it was, don't assess the fundamentals of this market by each day's trading. Really meaning when we see big moves, even moves like we're seeing today, that's not really fundamentally driven. The fundamentals today aren't 8% worse for companies than they were yesterday, and yesterday's fundamentals weren't 9% better or 6% better, than the day before that. So we really are just seeing more sentiment and fear-driven and kind of repositioning of portfolios that are driving these swings. It's not economic based, and that is typical for what we go through in kind of a drawdown. And at some point we will find that base, and then we'll see the economic fundamentals come through on that. Moving on up past the equity market to fixed income, because fixed income's been kind of interesting from what we've seen in the fixed income market. The main kind of bellwether index or benchmark for fixed income is the Bloomberg Barclays aggregate. It used to be known as the Lehman aggregate, and that got changed, and now it's the Bloomberg Barclays aggregate. And this is as of through the end of day on Monday. So bonds actually did well during that period and actually held up. On top of that, mortgage-backed securities and treasuries were positive. What didn't really work was corporate bonds, in particular high-yield corporate bonds. What we had been seeing in the fixed income markets is as interest rates had lowered, particularly last year when the Fed started lowering rates, there was this search for yield. And the search for yield's really been on for half a decade, but it really got magnified last year. And we saw corporate credit, people really jumping into corporate bonds and taking much lower yields just because they were looking for anywhere they could to get incremental yield. And what we're starting to see now is as people are starting to get worried that maybe we're now going to be in a softer economy, maybe I should be a little bit more worried about whether these borrowers are still good. And so there's a lot of selling out of corporate bonds, particularly high yield bonds. And so you've seen the returns to high yield bonds go down pretty significantly. And that's an area where we actually saw that and called that out and really reduced our high yield exposure and even to some extent our corporate bond exposure well in advance of this, because we didn't really feel like you were getting paid for that risk. And maybe to highlight that, this next slide is courtesy of Western Asset Management, who's a real thoughtful fixed income investment firm. The chart on your left looks at what we really call the credit spread or option adjusted spread. What this is like looking at a corporate bond, so say a 5-year corporate bond, and it's comparing it to the comparable treasury, so it would be a 5-year treasury bond, and looks at what's the difference in interest rate that you're getting on that corporate bond versus that treasury bond. And so the chart on your left looks at investment grade corporate bonds, so higher quality corporate bonds, and that spread had been about 90 basis points, 0.9% as of a month ago. And as of, and this chart is it's a really good chart, so I use it as of March 12th, that spread was 195 basis points, or almost 2 percentage points higher. So over the course of really a month here, we've seen a whole percentage point increase in the spread between Treasury bonds and corporate bonds. And in fact, today that's even a little bit higher than when it was on March 12th. So that's when, and if you recall, the way bonds work, when interest rates go higher, prices go lower. And so that's what you're kind of seeing in corporate bonds, which are kind of down, 4 to 5%, probably more like 5% at this point since February 20th. On the other side, the right-hand chart here looks at high yield bonds. So these are bonds that are BB, single B, or triple C rated or lower by the rating agencies, and they're viewed to have a little bit maybe more debt than the rating agencies, being Moody's and S&P, would like. The average high yield bond, which if you can look in the middle of the chart here on the right, says US high yield, their spreads are up 411 basis points, or a little over 4 percentage points from January 13th of 2020 to March 12th of 2020. But what's really interesting in the high yield markets is you getting to more, call it stable and less economically sensitive areas like wireless companies, healthcare, food and beverage, and their spreads are up. They're up 200 to 300 basis points, but it's more the extreme side in energy and leisure that have really been hit the hardest. So energy companies, their yields their interest rates are up over 11 percentage points from where they were a couple months ago. Same with leisure companies. When you think about hotels and resorts and cruise lines and the like, those are up almost 7 percentage points over the last 2 months. And so the high yield market, you're seeing a lot of bifurcation, and particularly in energy markets, it's really hard to do any deals in energy markets. So any energy company trying to go out and issue new bonds is having a hard time, let alone just somebody that has an energy bond and wants to sell it. It's hard to find somebody that's willing to give you a bid or to buy that and take that off your hands, particularly at any sort of size. And so the high yield markets is particularly kind of constrained right now. That we've seen that in other periods in the past, and it tends to be a long-term opportunity for investors. But we've seen spreads wider than where they're at today as well. So I guess one other comment I'll make before I kind of move on to the kind of coronavirus kind of conversations is also another area that we've allocated some of our clients' capital to is alternative investments. And so alternative investments, where we look at in alternatives is more diversifying, less correlated areas. And so those investments have held up as well. And so I was looking at our alternatives portfolio, and that's kind of roughly flat over this time period as well. So, I think the key in this is in periods like this stress, this is where diversification shines. Last year when the market was up 31%, your bonds weren't up 31%, your alternatives weren't up 31%, your international stocks weren't up 31% like the S&P 500 was. But in a down market like this, where the S&P's fallen 25%, your bonds are flat to up slightly. Your alternative investments are flat. It's providing that level of diversification, and these environments is where diversification really shines. So let's switch to kind of talk a little bit about the coronavirus and the impact from the coronavirus. And the way we're thinking about this is, there's a wide range of outcomes. We all don't know how long some of the quarantining elements are going to last, and where we really kind of get to stabilization in some of these curves that the government is talking about. So the way we kind of want to think about it is, let's think about the range of outcomes and how this could impact the U.S. economic growth, and particularly the GDP of the U.S. And so when we entered 2020, kind of our base case thinking was you might have GDP of 1.5% in the first quarter. There seemed to be a lot of pull through of demand into the fourth quarter of last year. Some of the trade stuff, while it had been agreed to, was still kind of figuring out how that would play out for companies. So we saw a little bit softer first quarter, getting to more trend-like 2% growth in the second and third quarter, maybe seeing some acceleration once we get past the election in the fourth quarter, for kind of a 2% GDP for the year. And with that baseline, we've kind of recalibrated and said, well, depending on what kind of comes out from the coronavirus impact, we could see a less severe, a more severe, or a high severity scenarios. And so the less severe scenario is kind of flattish GDP growth in the first quarter. We kind of see that across all scenarios. And the less severe would have about a 3% decline in the GDP. That would probably mean we're all kind of buttoning down and hunkering down for 3-4 weeks. And then after that can kind of slowly start to uptake our activity outside of our homes to the point where the third quarter is maybe still down, but it's not down a lot. And then we kind of get a nice acceleration in the economy in the fourth quarter. So kind of maybe more of a V-shaped recovery, some of the economists would say, with really that recovery maybe more so coming in the fourth quarter. The more severe scenario would be a bigger downturn in the second quarter, so a -7% GDP, but a more muted recovery as we get into the fourth quarter of this year. So kind of maybe something that's more of a U-shaped recovery, if you will, to use kind of the economists like to use letter terms to discuss kind of the economic cycle. And then lastly, the high severity is one that I would say is probably more of an L-shaped, where we are impacted in the second and third quarter, but we don't get a significant recovery as we get into the fourth quarter. Based on kind of the news and information we're seeing at present, I would say we're looking like the scenario is probably going to be somewhere between a less severe and more severe scenario. I think the market is clearly priced in the less severe scenario and is pricing in every day more and more of that more severe scenario. And so to give you kind of a sense of kind of where we're at in terms of what expectations the market is pricing in, that's kind of where we're at. And that's kind of how we're thinking about the coronavirus impact from a GDP perspective. From there, obviously, whatever the GDP is, that's going to impact what corporate earnings are going to be, and whatever corporate earnings are going to be is kind of going to impact what the level of the S&P 500 is going to be. That's kind of how we gauge our expectations from there. Let's shift a little bit to the oil market, because that was kind of something that had been softening, and then we got kind of a big shock last Monday when Saudi Arabia made the decision that they were going to cut prices by $6 to $8 a barrel and increase production, which was something that wasn't at all expected, and it was a big shift that rattled the oil markets, and oil prices are down considerably since then. Let's kind of, as I kind of walk through what I kind of see is going on, I think it's important to kind of understand the supply-demand dynamics of oil. If you go back to kind of basic economics and some of the economics I learned in college, oil actually tends to follow the laws of supply and demand actually pretty good. So on a demand level, we have about, the global economy uses about 100 million barrels a day of oil. And so that's kind of the base demand, and that's kind of continues to grow fairly steadily, kind of a couple percent every year. The supply of oil, believe it or not, the US is actually now the largest supplier. We're producing 18 million barrels a day of oil. The chart on the left actually shows kind of OPEC versus non-OPEC companies. So OPEC's the blue line on the bottom. And as you can see, really for the last 13 years, OPEC's been around a third of the global supply of oil they produce. But what's changed is over the last 13 years or so, non-OPEC companies, largely the US, have increased their share of global oil supply. And so the US now producing 18 million barrels a day of oil. A lot of that's coming from the shale deposits that we found, and our ability to frack and get that oil out fairly quickly and pump that through. That's really driven the increase in supply. Russia produces about 11 million barrels a day of oil. And kind of throughout 2018, 2019, Saudi Arabia had been producing about 10 million barrels a day of oil. I saw a statistic today now that Saudi Arabia has upped its production to the point where it's over 12 million barrels a day of oil right now at its current run rate. So what we're likely to see from a supply-demand standpoint is we're seeing more supply coming on, while at the same time there's less demand. So while we were kind of going into the year thinking 100 million barrels a day of oil, it seems less likely we'll be at that level. Now, oil tends to be less economically sensitive. There's some sensitivity there, but if you put it in context, in 2008, demand for oil was down about 1.75%, much less than the global declining global GDP. So you're likely to see, yes, less than 100 million barrels a day of demand, but probably somewhere between 95 and 100 million barrels a day still. So you have lower demand and you have increasing supply. So something's got to give. Oil's a commodity. It's a physical commodity. So we can put some on ships and anchor those ships at sea, but you can only do that for so long, and you can only do so much of that. So that means supply has to come off. So where does that supply come from? Well, the way to think about that is the marginal cost of production. Saudi Arabia is globally the lowest producer, cost producer of oil. Their oil is very shallow. They don't have to drill very far to get it. It's close to the surface, and so they can produce oil at $10 a barrel. Russia is a little bit higher. They're producing oil at roughly $20 a barrel. In the U.S., you can get a variety of different numbers on the marginal cost of production, but if you kind of think in a lot of the shale areas, it's the attractiveness of it is you can get of shale is you can get a lot of volume fairly quickly, and so that's the attractive piece of it. But it does cost around $50 a barrel, give or take. Each region, each basin has different costs associated, but $50 a barrel is kind of the general consensus of kind of what you want to use as your base cost of production. So with oil now sub $30 a barrel, it's Russia is still barely making money. Saudi Arabia is making plenty of money, but the U.S. is losing money on that. So the U.S. is likely the ones who are going to cut the supply and start producing less because it's less economical. For energy companies, now energy companies over time have learned from the volatility of oil prices and they hedge out their commodity. Most energy companies and oil producers are hedged for most or all of their production in 2020 at kind of average costs of around $50 a barrel. So if oil stays where it's at for the rest of the year, they're okay. Problem really becomes 2021, where if we're still at $30 a barrel or $35 a barrel or wherever, well below 50, it's going to be harder for them to remain economic. So at some point, it would be logical to see producers start to cut production, to cap their wells, no longer drill new wells. That will result in less supply coming out of the U.S., and ultimately that should yield higher oil prices down the line. This is kind of very similar to what we saw in the second half of 2014 through 2016 period. It just takes time to do that. For those companies that are hedged, you may not shut off your production immediately. You may still want to be drilling and getting prices at $50 a barrel until those hedges run off, because you're hoping maybe that the oil price recovers. So I think our view is it's unlikely that you're going to see oil prices revert back quickly just due to this supply-demand dynamic, unless Saudi Arabia quickly pulls back, but it doesn't seem like that's something that they would be likely to do. And I think a key part of what they're trying to do is to kind of reduce the U.S.'s impact. And if Russia wasn't willing to cut their production, they're using price and incremental volumes as a way of forcing the U.S. to cut their production. So that's what's kind of going on in the energy market. So let's talk about kind of general portfolio positioning and maybe thinking some thoughts of just maybe how you may want to think about your personal portfolio when we're going through kind of these challenging time periods. It's, we had, the longest bull market in history. And if you've been talking to your Telemus advisor through that period of time, we're always talking about understanding your risk tolerance and getting the right mix of stocks and bonds and alternatives into your portfolio. When the market's going up, it's a lot easier to say, yeah, I can withstand a 10 or 20 or 30% downside in my portfolio. And then once you actually go through that period like we've just gone through, it's a little different when you have to see that pain and actually see that in the values of your accounts. And so now's a good time to really revisit that risk tolerance. Are you still comfortable with how risky your portfolio is? If not, now's a great time. We have such great advisors that tell them this. Now's a great time to talk to them, and they'll be able to coach you through and think through what is that right risk tolerance for you. The second piece is, like I said, we had gone through this period, 5-year period, where we had extraordinarily low volatility. I think it's likely for a period of time we're going to be in a higher volatility time period. I don't expect it to remain at the level of volatility we've had, where we're having up and down, 5 to 10% days on a regular basis. I think that'll get muted at some point here. Again, once we kind of find a base where buyers and sellers are starting to meet up on prices. But it's likely with the amount of news flow and uncertainty around coronavirus that we're probably going to have elevated volatility for some period of time. So you need to couch that. Maybe that means for me that I'm tuning off the TV. There's just a lot of fear-driven news out there that really doesn't impact the near-term economics or the long-term cash flows of the business. And that's really how stocks are valued. The second piece on the volatility, and something that's not always readily talked about, is obviously there's a lot more money into ETFs or exchange-traded funds. The way exchange-traded funds works is they first try to match up buyers and sellers, and then if there's more money going in or coming out, those ETFs have to actually sell or buy that underlying holdings depending on what they're doing. They tend to do that in the last 15 minutes of the trading days. So what you've seen a lot lately, big down days, the last 15 minutes pushes the market down a lot further. On big up days, the market rallies really strong in the last 15 minutes because you have these ETFs buying on those given days. And so the ETFs are going to kind of mask the movements in the last 15 minutes. It's just the nature of how they trade. Don't read into that last 15 minutes just because the market was down 5 and ended up down 10 because the ETF was lower. There wasn't, a lot of times there wasn't any incremental news that came out. It was just market forces that pushed it back there. The second piece is, look, the news cycle is likely to get worse before it gets better. But again, the market is a discounting mechanism, and the market's already discounted in some pretty severe impact from coronavirus. So just because the news flow is bad doesn't mean that's not discounted into the prices. And kind of following up on that, market rebounds tend to occur before economic recoveries. If you're waiting for the economic data to say all is good, the market's going to be up much higher by that point in time. And so the markets do tend to lead out of this. If you actually go back to 2008, right? I think it was like March 9th, that was the bottom, and the market started to recover from there. But you didn't really see it in the economic numbers for another several months. In fact, I recall waiting in the summer of 2009 for the National Bureau of Economic Research to officially declare the recession over. So well after that market had recovered at that point in time. And lastly, I was talking to some of my colleagues yesterday, and I think they put it really well. It's keep in mind, why are you invested? Are you invested for the next month? That's a different discussion than if you're invested for the next 5, 10, 20 years. And if we look back, 2008 was an extremely painful period, but you look back over that time period and incorporate that time period, and you still have had pretty good gains. And so thinking about the long term, thinking about why are you investing, something to keep in the back of your mind. It's really hard to do that when we're looking at the markets moving around at the levels they are these days. So if we take that and kind of look a step further into the Telemis' portfolios and what we've been doing for our clients, I think for us, we had been reducing risk for the past year to 18 months in clients' portfolios. We like to think in terms of what's the reward, what's the opportunity set out there, and are we getting compensated for that opportunity set? And as multiples in the market started to go higher, we started to get put a little bit more cautious defensive posture in our equity portfolio. So that would include adding some lower volatility, both active and passive managers to our equity portfolios. In the fixed income portfolios, we had reduced the corporate bond exposure, particularly among high yield bonds, as we saw that as an area that was really not providing the reward for the risk you were taking. And now we've seen how that's kind of starting to play out. And then lastly, we do believe in alternatives and believe they help diversify portfolios. And so things that look at capturing volatility in the market are doing quite well in this environment. Things that are looking at kind of specialized income streams, those are doing quite well in the market. And like I said, our alternatives portfolios are kind of hanging in there and flattish over this time period. The other thing we did is in more aggressive asset allocation models, those that had more exposure to stocks, we were underweight stocks in those models because we just felt like the upside wasn't as great there. And so we'd kind of been a little bit more cautious in those as well. And lastly, we've added some hedges where appropriate during this downturn. And so try to protect some capital on the downturn, and those will come off at some point, but we've added those to the portfolios as well. If we kind of look at, well, where do we go from here? Everything we're doing is we're thinking about the opportunity set, goes back to that chart I talked about earlier around the coronavirus and the scenarios. We're really thinking about what are those scenarios are going to be and thinking about where the market is pricing in the scenarios, what's likely to happen. That's going to drive our decision making. At some point, we do think it's going to make sense to add risk to portfolios. And so we're actively having those conversations as to where that point is. I think we're getting closer to that point every day now, but we're actively looking at that and weighing that with the new news. And if our scenarios need to evolve over time, they will as well. And then lastly, we are really in the last week, we've really started to see some interesting dislocations occur. Value stocks are, while they've fallen more than the rest of the market, we're starting to see some attractive things going on there. Case in point could be regional banks. Regional banks are trading at 0.5 or 0.7 times their book value. Book value is essentially the value of the company if you just liquidated everything, sold all the assets, paid off all the debt, and what you'd have left. And so, some banks you could double your money today just by liquidating the bank. That's not really the best thing for the long-term interest of the bank, but that's how they're being priced today. With, banks are, I've talked to a couple of banks and they're in pretty good position right now. And so, yes, some are going to have some credit losses and you might not make as much money because you have lower rates, but your banks in general are actually doing okay. So I think there's some pockets of opportunities there. Infrastructure and MLPs or pipelines, those are ones that have sold off significantly. We think they're really under us. The market is kind of just throwing the baby out with the bathwater there and underestimating really the structural elements of those types of assets. And then lastly, municipal bonds. Municipal bonds have kind of had a unique environment. And that's an opportunity that we're paying particular attention to. And so clients that are putting new capital into fixed income are getting the benefit of this, or those that have bonds rolling off are getting the benefit of this as we're deploying capital into municipal bonds. And I'll explain what's going on there. So a way to think about municipal bonds is, municipal bonds are tax-free. I don't pay any tax on any of the interest. Whereas a treasury bond, I have to actually pay tax on that interest payment I get from owning that bond. So in theory, if you felt like a municipal bond was equal credit risk as a treasury bond, you'd be willing, if I pay a 30% tax rate, I'd be willing to actually get 30% less yield on that municipal bond than I would on my treasury bond, because when you adjust for taxes, I'm about even. And well, municipal bonds do have a little bit more credit risk than the treasury. They can't just issue money whenever they need it. So there is a little bit more risk there, although they are in pretty good shape in general. So historically, you've seen municipal bonds trade at interest rates that are kind of in between 80 and 100% of what the interest rate is on comparable treasury bond. So if it's a 5-year municipal bond, its interest rate is somewhere between 80 and 100% of what the interest rate is on a 5-year treasury. What we've seen of late is treasury bond yields have come down considerably since mid-February, while at the same time municipal bond yields have gone up considerably since mid-February. And that's what's really driving that is a lot of outflows and people are trying to sell municipal bonds, and that's pushing yields higher. The only way they're getting somebody that's willing to buy those bonds is at higher interest rates, to the point where as of yesterday, AAA rated municipal bonds are trading at 165 interest rates that are 165% of treasuries. So nearly double what they were a month ago. And so you're getting much higher interest rates relative to other things in a AAA municipal bond that has really strong credit profile. So that's a great example of some of the anomalies that we're seeing. You saw an anomaly like this during the financial crisis and almost to a similar degree. And it was there for a brief period of time, and then over time it kind of worked its way through. So these are examples of some of the interesting anomalies that we're seeing in the markets, and we're trying to be thoughtful about what of those opportunities are best to capitalize on for our clients, and when's the best time to roll into those types of opportunities. So that kind of concludes the update and on our comments. I think just kind of in summary, it's been a wild market. A lot of what's going on is not fundamental. It's sentiment driven. It's people repositioning their portfolios, people selling out other portfolios. It's more fear driven trading. I think we're getting closer to finding maybe a basing point where you're starting to see a level where buyers are going to start coming in and those are going to match with sellers. But there's going to be volatility for a period of time. I wish I could tell you a different answer, but I'd rather be upfront and telling you we will see volatility for a period of time, hopefully not to this degree, but we are in a higher volatility regime. But focus on that diversified portfolio over this type of time period, and at some point the market will lead the economy out of this as we move forward. So those are kind of my prepared comments. I guess we'll open it up to any questions.
We have a few questions that come in, and I just want to first give a big thank you to Matt. That was excellent. So first question, what is your assessment of the availability of bank loans to small business? Stated in another way, will banks restrict credit? What indices can we follow to track availability of bank credit?
It's a good question. So the actions of the Fed on Sunday were quite significant in my mind, and maybe I didn't spend enough time talking about that, but there's a lot to talk about here. One of the things, the Fed basically took off all the governors it could on banks to say lend as much as you can. And one key one there was they reduced the reserve requirement. So what banks used to have to do is roughly 10% of your deposits, they would actually leave at the Federal Reserve as kind of a safety capital. And the Fed said, you no longer have to keep reserves at the Fed anymore. You take that money and lend it out. And so I think the Fed's doing what it can to tell banks, feel free to lend. You don't have to use as much capital as you need, and we'll have all sorts of funding mechanisms to make sure you have access to that capital to lend to small businesses. And so, I mean, obviously, the challenge that any bank's going to have is you don't want to lend to a small business if, you know, in 30 days they're not going to be able to repay you. So that's clearly an area where I think the government and some of the stimulus measures that they're talking about, that, you know, having some mechanisms to help support that. For really small businesses, the SBA loans at least will provide some coverage because those are government backstopped. I think the government has a tool there to help small businesses. But, you know, it clearly is a risk. The smaller businesses that are doing a lot of the basic things that we use, whether that's places we get our haircuts or, you know, get our dog supplies or grocery stores or whatever, they are clearly going to have a harder go of it from here. And I think there are going to have to be some businesses, unfortunately, that go under from this. But I think some of the actions the government's taken, both on a fiscal and a monetary side, are doing the best they can to get funds out there to help some of these small businesses weather this period.
Okay, another one. What are the asset classes for alternative investments, particularly those that are performing well to drive the overall returns as flat?
Yeah, it's a good question. We've never, well, I shouldn't say we're not real big fans of kind of more traditional private equity hedge funds. Our kind of thought process all along, and I give credit to Gary Rand, our chairman, on this, is really to have diversifying alternatives. Hedge funds, private equity, they tend to correlate with equities. And so what we've really allocated to are we do have a hedge fund, but that hedge fund doesn't look at prices, it really looks at volatility. And so it plays in options markets and futures markets where it's really trying to capitalize on volatility. And as we've seen that VIX index spike, like that chart was, that strategy's done particularly well and really captured what we expected it to, is in periods of high volatility, they should do well, and they have. Other ones are just kind of core real estate that private real estate's done well. Those properties, the buildings, our office building isn't put up and bought and sold every given day. And so, but yet the tenants continue to pay their rents. And so that provides nice cash flow. There's also some alternative lending strategies that buy into litigation settlements, or music royalties, or some of those things, and they've done quite well in this environment as well. And so those kind of strategies collectively are what's leading to our alternatives component of the portfolio holding up.
Okay, another one. What criteria are you looking at in determining the degrees of severity in your slide?
Yeah, it's, you know, we've kind of taken the US GDP and there's a lot of good data as to the underlying components of that. So that can be services sectors and goods sectors, and then underlying that, even within services, you're looking at household services versus travel versus others, and really kind of stressing what could happen to each of those subcomponents of the economy. And so we kind of start with that as our base framework to think about, well, which of those are going to be impacted and to what level? And they are estimates and forecasts, admittedly. And then we also then take that ending output and then compare that to what we've seen during different periods of time. And maybe one thing to kind of point out, you know, my kind of baseline in thinking through this is there's different causes, obviously a lot of differences between today and what happened on 9/11 in 2001. But the similarities, you kind of had an economy that just kind of grinded to a halt for a short period of time. And even in that period of time in 2001, the third quarter only declined by 1.7% GDP, and the fourth quarter was actually positive by 1.1%. If you actually look at 2008, the fourth quarter of 2008 was down 8.4%, the GDP was, and then it was down another 4% in the first quarter of 2009. And so we can kind of take our assessments kind of from what I would argue a bottom-up basis, looking at each under the underlying components of the economy, and then look at that and how does that compare? Is that reasonable versus what we've seen during other time periods? And we kind of think, yeah. So that's kind of a brief explanation of how we're getting there.
Is it too early to begin investing, or will the coronavirus have a larger effect?
I'll start with, I'm an epidemiologist. I mean, I think that's, you know, we think it's good to be invested right now because, like I said, I think we're still trying to grapple with how bad is coronavirus going to be, but we don't know that answer, nor does the government know the answer. when we look at what scenarios the market's pricing in, we think the market's pricing in at least what seems to be a reasonable scenario now. So, but at the same time, the market is trying to find that equilibrium point between sellers and buyers. It hasn't found it yet. And so it's one of those where I think once it finds it, and if the coronavirus is kind of in line with what we're seeing today, I think now is a great opportunity. If we still take a little bit of while to find that equilibrium and coronavirus turns out to be a longer time period than what we're thinking, then obviously it might be a little bit early. It's not a great straightforward answer, but we're dealing with a lot of pieces of uncertainty here, and that's kind of how we're looking at it today.
How impactful do you think federal stimulus incentives will be for increasing consumer demand?
It's a good question. I've seen moving targets, right? Yesterday was $1 trillion. Today I'm seeing a headline of 500 billion. Obviously, if a good chunk of the population gets $1,000 checks in the mail, that's going to be a good thing. For some people, they may need that just to pay their basic bills. For some people, they may be fine, and it's just an additional $1,000 that they get to spend. And I think the one thing we have going on in our favor right now is with all the extra monetary stimulus out there, with banks being able to keep less reserves at the Federal Reserve, there's going to be more velocity of money, I would expect, out there, meaning there's going to be more changing hands of dollars. And I think that'll be actually pretty positive for the economy. So if it's based on a good chunk of the population getting $1,000 checks, I think that actually would be pretty stimulative. But it might take time to take effect. If we're all sitting in our homes, we might be less, some of us will spend that online, but some of us may wait until we get the all clear and want to use that to go out and spend it.
S&P and others have announced that they are not going to rebalance their indices, an unprecedented event. Do you think that they will have any impact to the ETFs or mutual funds that track indexes as we attempt to recover?
Yeah, that's a good question. I think one of the challenges I've had for a number of years is just when you look at, there's really 5 big companies in the US, and Facebook, Amazon, Apple, Google, Microsoft, that are big chunks of the indexes. And so how those indexes trade is how a lot of times where the indexes end up. It's, I think that does mask things in the short term. But we've experienced this before in the late 1990s. Cisco, I forget what it was, but that was high single digits of the S&P 500, and a number of other large tech companies were that way, and that kind of shook out over time. You also see that in emerging markets. You have 4 big emerging market companies that are 15-ish% of the index as well. And so that's unfortunately just kind of a nature of where we're at. And I agree, it masks kind of returns because how those big mega cap companies do really drives the indexes. But that's a big opportunity for active managers. Active managers can then make that decision. Do I really want to own Microsoft and Apple, or are there other stocks that I think can do a lot better? And I think that's going to be a huge opportunity for active management as we come out of this. Because if Amazon and Apple are the best stocks to own, those active managers will own them. But if there's other stocks that are particularly attractive, I think that's where these active managers can really provide attractive returns relative to the broader index.
Will the Fed / government's $1 trillion cash infusion kickstart an inflation cycle?
That's a good question. Given the actions of the Federal Reserve on Sunday, where they took a lot of governors that were there to kind of control inflation off, it very well could. I think the Fed's at a point right now where it would be very happy to have to deal with that problem versus other problems. And so, I would think over time it would, over a short period of time, I would say it's uncertain to me whether that would lead to significant inflation, but it's definitely a risk, no question.
What do you think mortgage rates are headed given the environment with coronavirus, QE, federal stimulus, supply and demand for housing, etc.?
It's interesting. We looked at mortgage rates yesterday, and they were up 0.75 of a percentage point from where they were at 2 weeks ago. And this was from one particular lender. And I heard a conversation with a bank CEO the other day who they do quite a bit of mortgage lending, and their comment is they just can't take new mortgage. Mortgage volumes are up 3x from where they were a year ago, and they just can't handle more volumes. And you're actually starting to see that now in pricing, where you're just not getting an attractive mortgage rate, even though long-term bonds are much lower rates than they were a month ago. And it's just because there's just now no capacity to handle that. So we have not seen mortgage rates follow treasuries lower, and I would not expect them to, just given supply and demand out there, or just the strong demand for mortgages out there.
You mentioned the nearly double yield on muni bond market, which seems like a good opportunity to buy now, but isn't there a unique risk factor since the municipalities are going to have an unprecedented expenses/burdens? How much of a risk of bankruptcy default is there for these municipalities?
Yeah, it's a worthwhile point to point out. There's clearly risks, especially if you're looking at airports or any sort of municipal bond that's maybe backing a stadium or special event thing. But within muni bonds, there's a lot of, your local school is actually doing pretty good. If they issued a bond related to a specific tax levy, those are doing just fine. AAA related and AA related muni bonds, and those are what we tend to buy for our clients. Those are going to be kind of more general obligation bonds, or they're going to be tied to a specific, very consistent revenue stream. So you're right to point out that we definitely are going to have some elements of the municipal bond market that could be under strain, but in aggregate, municipalities should be in pretty good shape. In fact, there's some municipalities, like the state of Minnesota, has a massive budget surplus. And so there's a number of municipalities that are actually doing pretty good right now. And that's part of when we're building municipal bond portfolios, or our municipal bond PM, Tom Huber, has been at this for a very long time. And he's very attentive to making sure we're not taking any credit risk with our municipal bonds. And that's what we're doing.
All right, a few more. What percentage of corporations do you think risk going bankrupt given low consumer demand and supply chain disruptions?
I don't know that I have a good number there. I think we're going to see in energy markets, we're going to see a number of bankruptcies. We saw that in 2014 through 2016 when oil prices retrenched lower, and balance sheets kind of got back in order, and now companies had started to issue debt more again to finance CapEx plans. And I think some of the weaker energy companies are going to go out of business. There's no question there were other corporations that are more levered as they go through this. The benefit they have is interest rates remain low, at least at this point in time. But yeah, we'll probably see some more bankruptcies going through this. To be candid with you, I haven't really thought about it or put pencil to paper to kind of figure out what percent that would be.
If shelter-in-place requirements are implemented in places like New York City and other market centers, how will this affect trading activity? Can traders trade remotely?
Yes. I mean, exchanges are, there's really very limited pit activity, even in Chicago here, where we have options and futures exchanges. Almost all of that is done electronically. So I don't really see that as being a big disruption at this point in time.
Any signs of run on cash?
Not really a run on cash. The money markets funds are a little clogged at the moment, and a chunk of that is as banks are trying to manage their liquidity, as they're seeing their lines of credit drawn down, which has been a challenge. So companies like Anheuser-Busch InBev just drew down all their lines of credit from the banks. And so whoever was banking them needs to then extend them all that money. And the reason Anheuser-Busch InBev is doing that is not because they're thinking of going bankrupt tomorrow, but they're looking at kind of the fixed income markets seizing up a bit and saying, let's at least have plenty of cash on hand in case we have a bond that's coming due, or maybe we need a little extra money to work through kind of short-term working capital needs. And so as a result of that, the banks are really focusing a lot of their loans and capital distributions out to fund those lines of credit. So they're not as active in the repurchase markets. They're selling some of their securities, and there's just not enough buying demand on the other end. I think the Fed is taking some very positive steps to try to shore that up. Part of that is calibrating it. You got to have the exact right amount of liquidity in there, and so it's going to take a little bit to figure out what that amount is. But they're starting to provide that there. But banks are in really good shape. Banks are a big chunk. I want to say they're 40% or plus of the money market fund market, and their balance sheets are in really good shape. Your energy companies aren't issuing commercial paper, so they're not out there. And so I think the underlying credits of the money market funds are actually doing okay. Here at Tellem is, most of our clients are in kind of government money market funds, and so those are really just in treasury bonds and mortgage bonds, and those are working pretty seamlessly at this point.
Are you starting to see opportunities in the oil market right now?
I think the simple answer is it's a little early, just because I don't think you're going to see energy prices rebounding quickly. MLPs, which are really the pipelines that ship the oil, if you will, from the well to wherever they're being held, largely Cushing, Oklahoma, those are particularly attractive. Those are assets that you get contractual guarantees or contractual volumes on it. So the long haul pipeline, so that could be from North Dakota down to Cushing, Oklahoma, that might be a 10 or 15 year contract. It's called take or pay. So you're paying regardless of how much volume you ship, and it's at a contractual price. The smaller pipelines are what they call gathering pipelines, and those will go from the oil well all the way to the long haul. So it just kind of connects kind of like the capillary system where it connects the well to the main artery. And those are 2 to 3 year contracts, also typically take or pay. And so these MLP assets are particularly attractive because they have a lot of contractual arrangements in place. Those companies have been doing a lot of work the last few years to shore up their balance sheets. A lot of them have gone from cutting their dividends to now raising their dividends, and they're trading at valuations we haven't seen before. So that's an area we see as attractive. But again, it kind of gets back to we want to just make sure that we're not too early in it in increasing our exposure there. But that's an area that in the energy space that if we had to put capital to work, incremental capital to work in energy, that would probably be the area we'd see the most attractive opportunities.
A few more. What are your thoughts of taking advantage of the volatility?
Yeah, it's something we've actively talked about. Like I said, in our alternatives portfolio, we have a manager that's really skilled at doing that. And they're really skilled at not only just looking at where levels of volatility are, but really comparing volatility across markets and using options to kind of construct attractive trades that offer really compelling rewards and limited risk if they're wrong. And so that's an area where we've seen a big opportunity is just playing volatility options contracts. And we've chosen to do that with a manager that's particularly specialized in that. It's interesting, just to maybe add one more point, like covered call strategies is an area where kind of my mind naturally gravitated to, and we've seen that. And covered call strategies have not held up. They're actually down in line with the S&P 500 on that. And a key reason for that is you've just seen the whole volatility curve shift up. And you've actually seen a shift in the curve where it's instead of actually upward sloping, it's now downward sloping. And so that's really impacted the ability to, I think, make a ton of money in just writing covered calls and taking advantage of volatility that way.
Opinion on the auto industry, including Tesla.
The auto industry has been obviously strong for some period of time, and a key driver of that has been leases. So go back a decade or so, and about 28% of cars were leased. I think as of a couple years ago, over 40% of cars were leased. So I think long-term, that's the big dynamic is, does that shift? So the challenge you have then is when nearly half the cars are leased every 3 years, you have a big supply of 3-year-old cars hitting the used car market. And so you had actually started to see in the last 3-4 quarters, used car prices started to decline just because you had a big supply of used cars kind of hitting the market. But I think that's a challenge for the auto market is if you do get a softer economic demand, not only do you have maybe softer new car sales, but used car prices are starting to get more discounted. So the difference in price between a used car and a new car is kind of gapping wider. because used car prices are going to have to go down if there's more supply. And so I think that's going to be a short-term structural challenge regardless of the economy for the auto market. You know, Tesla is, to be candid with you, is a stock that I haven't followed a ton, just because I know it's one there's a lot of noise, there's a lot of people trading it. It's really expensive on the long-term basis, but I get they have some great technology that is transformative, and definitely has some value. But I haven't, you know, built out a detailed discounted cash flow model to tell you what exactly that right value is.
If you were moving between various equities today, what sectors would you sell and buy?
Today is tricky because, again, we're kind of trying to wait for the market to hit that equilibrium point. What typically works coming out of downturns like this is value stocks do incredibly well in small cap as well. We saw that coming out of the tech bubble. We saw that coming out of the financial crisis. And then when I look at it now, small cap stocks are actually looking pretty attractive relative to where they had been, and value stocks are looking really attractive relative to history. And I think that to us leads us to think longer term, that's probably the parts of the equity market you want a little bit more exposure to. But if you go back to my earlier slides, those are the part of the market that have been getting sold off the most. And so it's an area I think at some point in time you want to add exposure to. You just want to be a little bit more thoughtful of the exact time you want to deploy your capital into that.
Okay, two more. How long do you expect the recession to last? How easy will it be for us to dig ourselves out of this versus 2008?
Yeah, I think we're kind of in the U-shape kind of recession. I think second quarter is probably not going to be pretty. I think you'll still be a little bit softer in the third quarter as we just kind of work through getting people back to work and resolving some businesses that are maybe struggling. But I think you can come out of this pretty strong. The economy was really strong even through the end of February. And so if we can get past coronavirus in time periods that are consistent with what's kind of you're seeing in Hong Kong and South Korea, I think a U-shaped recovery is quite reasonable expectation. Will it be bad as long as 2008? I don't think so, because 2008 was different circumstances, and it was, the banking system was in trouble. There wasn't a lot of solvency in the banking system, and there was a lot of concern there. There's no doubt banks are going to have more defaults and more credit costs as a result of what's going on, but their capital levels are extremely high. There's been changes in the market where banks have been able to securitize and sell off a lot of loans to the market. Those are actually put into bank loans that are traded as bonds. And so banks, the quality of their balance sheets has really never been stronger. And so I don't think this is a market where you're worried about the underlying financial system giving way. This is more a typical recession that was fueled by a medical issue more than anything. But it's you're going to have some businesses that go out. You're going to have some people that are out of work, and you're just going to have to get them back to work. You can get confidence higher, get business confidence higher. But I think we can work through that as 2020 progresses along.
All right, last one. What are your thoughts on foreign equity markets, emerging and developed?
It's a good one, and we've been actively debating and discussing across our investment committee. They've fallen in tandem with the U.S. One could argue some elements of the globe are ahead of the U.S. in terms of dealing with coronavirus and moving beyond it. The U.S. is still the dominant economy along with China, but still the dominant economy. And so what happens in the U.S. is going to impact other economies globally. Long term, we are particularly attracted to emerging markets. We think the growth in emerging markets is going to be much greater than that of the U.S. and other developed markets. So long term, I think we would expect to have more exposure to emerging market stocks and even emerging market debt potentially. But also it's thinking through, right now emerging market stocks aren't a whole lot cheaper than the U.S. stocks if you kind of look at where they've historically traded. Emerging market stocks always trade at a discount to the U.S., but that discount is kind of where it typically normally is. And so, the challenge you have when you invest outside the US is you also are making, whether you want to or not, you're making an implicit call on where does the dollar go. And that's a challenge. The dollar is in demand right now. People can't get enough dollars. It's likely the dollar goes higher over the short term just because there's such demand for it. And a higher dollar means a little less returns for anybody that's investing in companies outside the US. And so I think long term, we're particularly attracted to international markets, notably emerging. Short term, I think we're comfortable with our current exposure where we're at given the strength of the dollar.
So with that, I'm going to wrap up the webinar. I want to thank everyone for joining today. We will going to continue to do this on a regular basis as the markets continue to be with the volatility. I also just want to plug, we have another webinar that we're going to be doing on Monday with Dr. Carl Lauder, who's an infectious disease doctor at a hospital here in Michigan, doing a Q&A session on the COVID-19. So look into your email box. We'll have email out shortly with the registration page for that. It'll be Monday at 4 p.m. If you have any questions, please feel free to reach out to anyone at Telemus, your advisors, or just fill in a contact us form on the website. And thank you again to Matt Dimitrison. Great job.